This is, I like to call this critical mass. It means a slow buildup until something explodes, it just pops. This is a asymmetric, slow, long buildup, quick, sudden fall. So this is reality right here. So when we can see that the downside happens much quicker than the way up. The thing is, options aren't priced this way. So when you buy puts are fundamentally cheaper. They're fundamentally, how should I say, buying puts is fundamentally more attractive than most Black-Scholes pricing offers them, because they give them the implied volatility of a slow buildup, same as the calls. So that's why I like to look at far out of the money puts, especially far out of the money puts, which are really heavily underpriced. A lot of them, market makers, they just set these small prices, and because they're so far out of the reach that it doesn't even make sense. They think they're just going to collect the premium and it's never going to hit there. But as we see, volatility is much more common than many expect. Thus, if you buy puts, you can actually it's more attractive to buy puts than buy calls, just because of how frequent a sudden crash and the volatility down happens compared to on the way up. Sorry, I know this might be kind of confusing, or if maybe I'm not explaining it correctly. It's, this is kind of complicated subjects, and I try to make it simple. There's a big thing also with, in finance, there's quantitative finance. But I use pretty much no math when I do options. I don't know if any of you followed some of the option plays I've done this year, but luckily some of them have been great. But I've used no math on these at all. And I kind of want to start something. I'm thinking about doing a book called Qualitative Finance, which is more subjective. And it just shows that you don't need to price these options with these crazy theoretical models to make money. You can take advantage of the people who want to fit real life to the model, where that's, obviously not practical. Now, the reason I also like options is, so when you buy options, you have convexity. Convexity is basically, you have limited downside, unlimited upside. So the most I can do on let's say I buy $1,000 option for a 1 year put. Let's say the put, I buy it on GM. GM doesn't go down. All I do is lose $1,000, so it's less than $100 a month. But let's say GM does crash and the put goes up tenfold. And that, technically, theoretically, can go up as high as, unlimited. But the point of getting is that the most I can lose is that $1,000. Whereas so pretty much why I started doing this actually was in 2015, I was really long gold stocks, right? I thought gold stocks were going to be I had a big thesis over it and everything. And I put 50 grand in gold stocks. But the thing is, I didn't realize it would take longer for my thesis to work out, or for the market to, pretty much happen as I believed it would in gold rally. So stocks fell 50%. I had a family emergency basically happen. My dad passed away and there were medical bills. I had to sell low because I was illiquid at this point. And I was like, God damn it, I'm screwed here. So I had to sell at a 50% loss, making things even worse. In 2016, I'm sure a lot of you know, gold rallied. Now the thing was, I realized at the beginning, I could have bought $50,000 worth of equity for $5,000 in options. And the worst case scenario, I could have just lost the $5,000. I would have had the $45,000 left over. Then I could have just done $5,000 again the next year, and so forth. I ended up making 19-fold on the $1,000 options I bought, because I was so convinced that gold was going to go up. But back then I was just more speculative and just thought I was right. And luckily, the market worked out. But it just goes to show you why since then I've been obsessed with optionality, just making it so that my downside scenario won't ruin me, helps me sleep better at night. If I lose $1,000 over a year on calls or puts expiring, it sucks. But the thing is, from my experience and from the market, actual practical history, volatility in the market is much more common than people price it. The thing is, we're not competing really against the option pricing. It's like we're competing against the perception of other investors. Another thing I like to really do is, I think getting in on the cycle is where it's important for options. For instance, if you're at a top, and this is kind of where it takes experience to build. When you're at the top, calls are very expensive and puts are very cheap because people judge with the hindsight bias and the recency bias. They pretty much think the immediate future is going to reflect the recent past. But we all know that that's that's a human cognitive flaw that doesn't work out that way. So when you're at the top of the cycle, you can actually buy puts much cheaper. That actually, because the market doesn't think that they're gonna happen. It's like in when insurers happen. If there hasn't been a flood for a while, they lower their premiums. But eventually, things. What is that? Sorry, someone's using a buzzsaw outside. Okay. So yeah. So basically, what was this? Yeah. So you can, using cycle theory, you can take advantage of cheap puts at the top and cheap calls at the bottom. Imagine if how cheap you could have loaded up on call options at the bottom of 2008 when everyone was selling and getting out. Or right now, uranium. I've written on my website and also on Twitter that I've been buying uranium calls just because I think uranium is at the bottom phase right here, and eventually, hopefully it'll go back up. Bear markets become bull markets become bear markets. They're reflexive cycles. A bear market literally can create a bull market because the cheap prices will eventually stimulate cut supplies, blah, blah, blah. You get the point. So basically, yeah, the main reason I like the options, and everything I do about options or optionality or asymmetry, it goes into this book. I call it tail hedged. And basically everything I put in here, I just fill this thing out top to bottom with options and how to do good strategies and more or less, above all, how to gain from volatility. So most people get crushed when it's, a stock falls. But what I really learned from Nassim Taleb and his work Anti-Fragile was that why can't you harness this energy, this part of the cycle, instead of timing it and saying, oh, I'll get out before it crashes, which nobody does. Why not set up a part of your portfolio that'll actually benefit from this part? So that's kind of what the Anti-Fragile is and why I like the optionality. And I think it's really important for investors to have. You don't have to be a genius at math to be able to use options. I think that's a myth, or I think it just intimidates people when they think they must use when they have to use a really, harsh, complicated math. Back in the old day, they used just relative supply and demand. So yeah, I just wanted to go over this with you guys and explain to you why I like options and the asymmetry of them, and I find them attractive compared to other assets, and how I believe they're far more often mispriced than the market actually realizes. It gives us an edge, and I hope that it continues this way. And I would rather be wrong 4 out of 5 times, losing $500, than blowing myself up once. And I would rather be wrong 4 out of 5 times and then that 1 out of 5 make a 10-bagger, 1,000% return, than be right small amount of times, small gains 4 out of 5 times, but then lose it all or lose half of it 1 out of 5, which is kind of what the general market does. So yeah, I just wanted to say a few words on optionality and everything, and hope you guys enjoyed it. I plan to do a little bit more live videos. So yeah, thanks guys. Enjoy the rest of your day.